Welcome to another episode of Tambarara. My name is Tafaram Tutu, and today we'll be looking at First Capital Bank. With me today is Fanuel Kapanje, affectionately known as FK. He's the finance director of First Capital Bank. And today he'll be sharing some insights about the bank and just giving us an overview on what's happening within the bank as a whole. So without wasting much of your time, let's get to it. So, FK, the first half of the year has been quite turbulent, to say the least. As a bank, can you please take us through the key highlights of your performance?
Thanks, Tafara, and good afternoon to you. I'm glad to meet with you today. Right, so I think, like you've just highlighted, it's actually been a very turbulent, period, the first half of the year, and our performance during that period, must be understood in the context of that turbulence that we've just mentioned. The key issues from a macroeconomy environment would really be, the inflation outturn during that period. You would have seen when you compare with the past year, there's been a bit of an acceleration in inflation, closing at 191.9% year on year at June, compared to 60.7% at the end of December 2021. So inflation, accelerated during that half-year period. But again, we also saw quite a lot of movement, on the FX market, with the Zim dollar devaluing on the official market by some 237% during that period, right? So it was quite a turbulent environment, so to speak. Over and above that, liquidity was an issue, and I think it's a story that's been told many times, on the market. But that notwithstanding, as a bank, we were able to post, some really, I would call them impressive results, underpinned by real growth in the underlying business itself. So we saw our deposits growing over the 6-month period by some 14%. That is in real terms after you've actually adjusted the December figures for hyperinflation. At the same time, we saw an acceleration in demand for credit, with our loan portfolio increasing by some 37% during that period. And most interestingly, the balance sheet has progressively become skewed towards foreign denominated business, so to speak. So out of this loan portfolio that I'm talking about, 68% was actually underwritten in foreign currency. But that said, we still managed to maintain a very impressive, I would say, non-performing loan ratio. So our assets were quite clean, with an NPL ratio of about 1.7%. Now, with that background, we saw an expansion in our income, posting an outturn that was 57% better than what was posted in the corresponding period in 2021. And when we look at that growth in income, we are noticing an expansion in net interest income by some 12%. We're also noticing our fees expanding by something in the region of about 18%. But notably, there's a very significant contribution to our income outturn that's coming from the reevaluation of the foreign currency position that we've got on book as it continues to increase, and as we experience the devaluation of the local currency, we then end up with a credit that's coming to the income statement, which is quite positive in our favor. Now, because of the environment that we're operating in, We've also seen our operating expenses expanding quite aggressively by 34% when you compare the two periods. But the most interesting thing out of that outturn is the fact that our cost to income ratio, which is our efficiency ratio, is actually improved to about 58% compared to 68% in 2021 during that corresponding period. But I mentioned, the acceleration in inflation. The cost of that inflation acceleration is a net monetary loss charge to our income statement, which for 2022 comes out at about 18% of our net operating income. Right, that's quite significant, and it's an increase from about 3% that would have been posted in 2021. And I think it just underlines the impact that inflation is having on the operations. So that said, we still managed to post a profit in inflation-adjusted terms, 472 million, which is a drop, just a slight drop from prior year. At 483 million. But however, when you then look at the attributable income, there is actually quite is the total comprehensive income quite significant at 5.3 billion compared to 754 million. A big part of that coming from the revaluation of some of the investments we have on book, which really go a long way to protecting our capital, so to speak. So I would say, at a very high level, that's been the performance of the bank for the first half. We were able to declare a dividend, which we've paid, and I think that's something that's quite positive in terms of us giving a return to our shareholders.
Yes,
thanks.
Quite a pleasing performance in the first half.
Thank you so much.
So, moving forward, you've painted this picture that things have been quite difficult, but the bank has managed to be resilient.
Yes.
You've moved to more USD business, and you have a stronghold in real assets that are defending the balance sheet.
Yes.
But with all this that's happening, we still see that there's still strong demand for the ZWL, and with what has been happening with the central bank and the authorities, holding tightly to the local currency.
Yes.
How is the bank coping with that? The high demand for ZWL and the tight hold that we're seeing in the economy, and the high interest rates that are coming with this local currency.
Okay, so it's really been a very delicate balancing act, I would say. There is actually throughout the periods, there's actually been a heightened demand for credit, both in Zim dollars and in foreign currency. Now, as far as our Zim dollar position, what we've generally been doing, we have been very, very prudent in maintaining our cash flows, ensuring that at any given time we don't overexert the balance sheet to a point that we are actually short in a sustained sort of manner on our Zim dollar position. What that means is that from time to time we've deferred release of liquidity to some of our clients who require access to that liquidity. But essentially, we've generally operated with a very comfortable buffer in terms of our liquidity requirements, so that we're able to roll and drip feed the pipeline of credit and some of the requirements we have for that liquidity. So it's been a very delicate balancing act, but the best we can, we've been able to facilitate access to our business partners. Now, speaking to the high interest rate regime, right? I think it's really demanded of us, to ensure that when we really evaluate, requirements for credit, we are very clear about the absorption capacity of the obligors that are coming on book. So it's a rigorous analysis that we do, and we're very, very careful in doing that, because we recognize the fact that if we just release credit willy-nilly, the reality is that we can actually end up creating non-performing loans because of the high interest rate regime. But all that having been said, we've still been able to maintain a fairly reasonable book, notwithstanding that interest regime that prevails at the moment.
That is quite impressive. Maybe I might be coming to you for loans after.
You should actually. You should, yeah.
So okay, you've given us a clear picture on what's happening on the ZWL front, and I just want to unpack the USD front a bit more. Yes, the USD book, 68% of that is now made up of USD.
Yes.
And I'd like to believe that in part it's because of the devaluation of the local currency. But we've also noticed that all over the sector, banks have managed to get lines of credit. The international banks.
Yes.
We see other banks getting lines of credit from Afreximbank, others from AFDB. According to your statements, you got one from
EIB.
EIB. Yes. So could you please give us an update on how much have you drawn down, and what are the terms, if you can disclose that?
Okay.
And if it's a sustainable extra source of income that could help you or boost your business going forward.
All right. So certainly. So the line we got from EIB is for 12.5 million euros. And it's a mid-term facility that's running up to a maximum of 7 years. Now, naturally, with these lines, when you get to the point of drawing down, there's quite a significant amount of due diligence that you've got to undertake on the downstream borrowers. In our case, out of that 12.5, we currently have a pipeline of about 19.7 million euro, thereabouts. And these are different customers that are at different stages of evaluation through our joint processes between ourselves and EIB. And we should expect drawdown to start happening before the end of this financial year. Now, speaking to the issue of sustainability, I think we would like naturally to underwrite or to partner with more financiers, to bring in a lot more facilities that are able to support particularly the export business that we have on portfolio. That way, we believe if we're able to generate more and more foreign denominated revenue, sustainability of our operations, in the short term will be guaranteed, because we also see what's happening generally in the macro space. So there is a lot of demand on us to meet obligations in foreign currency, and we can only do so if we are able to generate the income in foreign currency, and these lines do assist in that respect. As far as the costs to the beneficiaries of these lines, naturally that's actually driven by the risk associated with each borrower. The way pricing is done is that there are factors that are loaded onto a base rate, which reflect the risk profile of individual obligors. But generally, these are prices that are quite reasonable. And we think for people that are looking to support their operations in the medium term, it's a facility that is quite manageable.
And you're talking about exports and just Zimbabwe being linked or connected with the global economy and all that. And I just want to bring in the fact that First Capital is a subsidiary of a bigger bank.
Yes, that is true. Yeah.
Footprint. So how is the parent company? Is there any role that the parent company is playing in supporting the vision that you and your team have in growing the local book and the local business?
Yes, quite a lot actually. In fact, we do benefit, from the regional footprint quite extensively. Recently, we've actually been able to, structure, trade transactions, between players that are operating in the region in countries that we've got, presence in. This is places like Mozambique, Botswana, Zambia, Malawi, and of course, we've got an administrative office in Mauritius as well. So we've been able to utilize that, group kind of architecture to provide trade solutions to customers that are operating in the region. But over and above that, you also find that through our group linkages, we are able to mobilize correspondent banking relationships. So the network of correspondent banks that we've actually built is actually earned leveraging some of the capacity that comes from group, right? Over and above that, we are able to solution for our customers in places like access to cash, repatriations, and other complex transactions, just utilizing that network. So we leverage that group experience quite extensively, both in providing customer service and also in ensuring that we manage our operations with the least cost possible by leveraging capacity that is available from the group.
Okay.
Yeah.
So it seems you're doing well in terms of giving value to your customers.
We try.
But maybe let me step aside. Let me take another turn and let's look at value to shareholders. Lately, what we've been seeing among listed companies in Zimbabwe is that some of these businesses have been declaring dividends in USD and ZWL. I think it's quite it's a testament of good performance if you're declaring a dividend in
Yes.
such an environment.
True that.
But maybe I'd want to know, is there scope for you as a bank to declare USD dividend sometime in the future?
Well, if you say sometime in the future, they probably could be. But I think it's really a discussion around affordability, isn't it? In our case, what then determines whether we do that or we don't is probably one of two things. One, the quantum of revenues that we are able to earn in foreign currency. I mentioned the contribution to the book that we are getting, but as far as the revenue contribution coming out of that business, it's something that is still building. And as I speak, we're now speaking to somewhere in the region of about 35% of our total income being generated in foreign currency. So we've not yet gotten to a level from a capacity point of view that we can actually say, let's actually declare this dividend, and mostly in Zim dollars, and actually dole it out in foreign currency. That capacity still has to build. Then again, it also then becomes an issue of liquidity in terms of that foreign currency liquidity at the end of the day. And at any given point where we declare the dividend, we then look at those dynamics and also look at the demands for that liquidity for some of the business generation activities that we undertake. I've indicated that we are having an acceleration of demand in credit. A significant part of that is actually foreign currency denominated, and therefore, that is a demand issue we then must manage as we consider the play on dividends.
So, you've talked about the, growing and accelerating.
Mm-hmm.
So if I take if I go back a few years, and look at the banking sector,
Yes.
in 2013, the sector's loans to deposit ratio was at 72%.
Mm.
That ratio fell down to some 31% in 2018, and as of the half year, it's up, to 56%.
Yes.
Do you think that as a bank there's scope to go back, back to 2013 levels of 72%, despite what's happening in this economy?
I think there is a scope, for that, and it really is spoken to in the sense that when you look at the productive sectors of the economy, what's actually happening in there, because those are the consumers of that credit. I get the feeling and the sense that there is a lot of resurgence that you observe in the productive sector. If you walk around, the companies that are coming back up, the new companies that have come on board, all those enterprises require funding to rekit. They also require funding to sustain their running operations. So demand for credit is something that, notwithstanding some of the measures that have been implemented more recently, some of which may actually end up being of a short-term nature, when you look at it from a sustained point of view, from a sustaining point of view, I think the demand for credit is definitely something that is looking up, right? Just to support the economic rebound that we're seeing happening on the market. And if that is the case, then the push on the loans to deposit ratio is likely to be something that we're going to see happening. But of course, the authorities are very keen to also ensure that through credit creation, we do not accelerate money supply on the market, and therefore there is going to be that moderation coming in always. But I think in terms of the projectile, yes, I would seem to get a sense that LDR should actually be going up. Yeah.
So, and I want to bring into perspective the aspect of technology.
Yes.
Back then, or 10 years ago,
Uh-huh.
we didn't have the strides in terms of technology that we have now.
Yes.
So I'd want to know from your perspective, as a bank, how have you leveraged off technology in the past couple of years, and how do you plan on continuing leveraging on technology going forward?
All right. So, as a bank, we believe in let me call it a digital first operating model, meaning that whatever we do, our interactions with customers, what we do internally in managing our processes, as best as possible, to the extent practical, we must actually have technologies deliver as the point, the first point of interface, right? To the extent possible. But having said that, we also an institution with a human face, so we also like to interact with our customers, particularly on a face-to-face basis. So it's a balance that we like to strike. We give you the convenience as a customer, encourage you and promote the usage of that of the platforms, whilst if you so desire, we're still available to be able to engage with you. What we've then done in setting out that journey is that over the last couple of years, since the coming in of First Capital, which is like 4 or 5 years ago, the focus was about building the core of the business in terms of the core technologies that we require in order to deliver the business. That is, your core banking systems and stuff like that. Migrating from legacy systems that belonged to Barclays. That has been achieved, and now the focus has been around building around those core technologies, applications that then enhance the service experience at the customer end. And you will have noted recently we have launched quite a number of interesting applications. We've launched a mobile app, which is I would say best in class when you compare with what's available locally. We've also launched an internet banking platform. Very, very interesting offering. It's really just been going out of the launch phase now. A few teething problems during the launch, which we've actually gone past, and it's a platform that I would really encourage any one of our customers to try. But over and above that, we also playing even in the social media arena. We've brought banking into social media through WhatsApp banking, and there's a whole lot of other innovations that we're looking at that we think are going to enhance the digital experience. But the focus here is about convenience to the customer, costs, lower the costs of providing a service to the customer as well, whilst at the same time we're improving efficiencies as far as our processes are concerned. That's the focus, and we're going to be on this digital journey quite aggressively even as we go forward.
And have you made any strides or efforts to tap into the unbanked population of Zimbabwe? Zimbabwe is quite 50% of the population is unbanked.
Yes.
And I think therein lies an opportunity for banks to also tap into that. Have there been any strides or moves towards addressing that gap?
Yes, we've really been looking at that space, and in fact, some of the products that I've just mentioned are intended to provide access to banking services to those sort of communities. Like, for instance, your WhatsApp banking. Really, that's anybody can subscribe to to that platform. Our mobile banking platform as well. USSD is available, and anybody can subscribe to that. But we very deliberately look at this market, the unbanked market, so to speak, and try to provide bespoke solutions to sectors on the basis of the specific need that exists in those markets. So recently we solutioned for the tobacco sector, the tobacco farmers. Quite a number of them would not have had the platforms on which to transact. and we actually provided them facilities in Karoi and Rusape. We also been looking at places like Mvurwi, right? So we provide solutions to the unbanked on the basis of need that is actually being analyzed and is supported by substantive information. We also on a drive to expand our agents banking network, and I think this is something that we're going to be talking more and more about as we go forward. But we think it's a solution that's going to bring our services even closer to some of these communities that are not covered at the moment.
That's yeah, I think that's quite insightful, and I think you're very focused and you have the eye on the ball there.
Thank you.
So we've looked at the bank. Maybe
Yes.
let's move away from the cooperations and just maybe unpack any plans that you have to build other operations of the bank. I understand that you have some leisure assets and you have the underwriting business for insurance that I think you've started doing. What other, what more, or what other lines of businesses that
We've been building. Okay. Right. So bank assurance is actually something that we've actually been doing for quite some time now in partnership with Zinet, who are our underwriters, and it's a service that we are expanding so that we get more and more for our customers to utilize that platform. And the idea there is to try and make the experience enjoyable, make access to the service easier. So that's one that's been in the pot. We're really just refreshing it. Then as far as some of the lines that we've been looking at, we've been looking at the money transfer service, and in the last few months we've actually expanded that offering. As I speak, we are actually partnering with about 4 agencies, and we're seeing that business growing quite a lot. And I've said earlier that we do benefit quite a lot from our regional network. So for us, mobilization of cash is not one of those things that is too difficult, and it renders our offering from a money transfer point of view a lot more accessible, fast access to money, shorter queues and stuff like that, right? So that's that. Then we do have quite a few other things that we do within our CIB unit, particularly the investment banking unit of the business. We solution for corporates particularly on a bespoke basis. And I think where corporates are looking for capital, where corporates are looking to restructure their operations, where corporates are looking to re-energize their business in a financial sense, we do have solutions that we can offer through our investment bank. So there's quite a lot that is in the pot, and I think we invite customers to come and sit with us, talk to us. We don't like to give you a general solution because we don't believe that all companies are the same, all individuals are the same. They are not. So we solution to your requirements.
Exciting times ahead for the bank. And just before we end this segment, I just want to ask on a lighter note. I remember earlier this year you had a competition.
Yes.
And I think the prize was a vehicle.
3 of them.
3 of them.
Yes.
When next are you going to have another one like that?
Are you looking for a car, Tafara? Well, tell you what, we really like to reward loyalty, right? Customers that have done business with us for the long term, we like to get them to feel that they are actually part of the business. And this was just one of many different types of promotions that we're going to be running, for our customers. And I think we're going to try and make it fun, enjoyable, but also make the rewards meaningful to the customers. So if you don't have an account with us, you really must think twice about that.
Well, folks, there you have it.
Yeah.
I'll be opening an account soon after this. I don't know about you. But until next time, this is goodbye.
All right. Thanks for that, Tafara, and thank you.
Thank you for the opportunity.
Thank you.